Are you an investor looking for premium market opportunities? Presenting premium and exclusive service for investors by Kalkine.
European Union governments remained split on Thursday over what level to cap the Russian oil prices at to curb Moscow's ability to pay for its war in Ukraine without causing a global oil supply shock, with more talks possible on Friday if positions converge. And the EU states failed to reach a deal on the price level for Russian sea-borne oil on Wednesday because of the Group of Seven Nations, or G7, proposal for a cap of $65 to $70 per barrel was seen as far too high by some and too low by others. The European Commission, the Czech EU presidency, the United States and G7 presidency Germany were all engaged in talks on Thursday to bridge differences and reach a deal before the price cap is due to come into force on December 5th. One of the EU diplomats said there are a lot of bilateral talks going on now at very high levels, and there will be a meeting of representatives of all the EU countries once there is progress. There's no point in calling another meeting if there is no change. Diplomats said that 6 of the EU's 27 countries oppose the price cap level proposed by the G7, and Poland wants the cap to be set at $30, arguing that with Russian production costs that some estimate at $20 per barrel, the G7 proposal would allow Moscow too much profit. Lithuania and Estonia back Poland. Adrian Biernacki, a spokesperson for the Polish representative to the EU, said, in principle, Poland supports the price cap on the Russian oil, but the proposed level is extremely too high. He also said that this level should refer to the production costs per barrel of crude oil and not to current market price. Some 70 to 85% of Russia's crude exports are carried by tankers rather than pipelines. The idea of the cap is to prohibit shipping, insurance and reinsurance companies from handling cargoes of Russian crude around the globe unless it is sold for less than the price set by the G7 and its allies. Because the world's key shipping and insurance firms are based in G7 countries, the price cap would make it very difficult for Moscow to sell its oil, its biggest export item, accounting for some 10% of world supply, for a higher price. Cyprus, Greece and Malta, countries with big shipping industries that stand to lose most if Russian oil cargoes are obstructed, argue the cap is too low and want compensation for the loss of business or more time to adjust. And Cyprus is especially concerned about tankers sailing under its flag changing their registration to other flag of convenience countries outside the EU like Panama or Liberia. Russian Urals crude oil already trades within the discussed range of around $68 per barrel. Eurointelligence think tank in a note said that means the proposed cap would either be the same as or slightly higher than the price Russian oil is fetching on the open market. It would be, in other words, another price cap that does not cap. All right, thanks so much for watching. Please do like, share, comment. Keep watching for more market insights and business news. Sage for Kalkine Media.